All right, what's up, everybody? Welcome to this week's Cryptocopia Live AMA. Cryptocopia is a community focusing on all things cryptocurrency. It's perfect for seasoned vets and beginners who are new to the space. I'm your host, Michael Kripkala. You can find me on Twitter, on Discord, at Mike Spellcheck. And today, we are joined by CRYPTAX, otherwise known as Igor Gomes. He is an enrolled agent licensed and authorized by the U.S. government to practice before the IRS, the Internal Revenue Service, in all areas of taxation. During his 24 plus years of experience with his own accounting firm, he's developed quite significant knowledge in areas like domestic and international taxation laws, domestic and international corporate structure, entity filing, accounting, tax return prep, filing, the whole gamut. And he's also an expert in cryptocurrency filing. So we brought him on today with the IRS deadline pretty soon, April 15th. Igor, how are you doing?
I'm doing great. How are you, Mike?
I'm doing pretty well. It sounds like there's a bit of an echo, so I don't know if there's something we can do to work on that. But I just wanted to ask you how long have you been prepping taxes as an enrolled agent, and how did you get your start working on crypto taxes?
Well, I actually, preparing taxes has been over 24 years that I've been doing this. I've had the enrolled agent license a little less than that. But cryptocurrencies, I received a phone call in the beginning of 2017 from my brother, who's been in cryptocurrency for a few years now, since 2013, I believe. And he basically called me and he goes, I'm a bit desperate. I said, okay, what's going on? And he said, I think I made a lot of money and I'm very worried about taxes. What do I do? So obviously that's a great problem to have. And so I began delving in and I ended up falling in love individually with cryptocurrencies. I'm an investor myself, part of a few groups that invest as well. But what really drew me to it is trying to really bring in a solution to a lot of situations like my brother had, which is, hey, what do I do now? And that's kind of how I got involved. And since then, we've been able to develop quite a few things to help crypto investors to make sure they're obviously properly filing their returns and making sure they're paying the correct amount of taxes, always focusing on paying them the minimum amount of tax possible with the most amount of protection, I guess we could say, or the least amount of exposure possible. So that's kind of our focus.
Okay. I think exposure, that's really interesting because I can't think of a single other area of, I guess, finance law or just regulations in the US where there's just a complete hole where, yes, we have notice from the IRS that you're supposed to pay taxes on your crypto gains, but it's really all they say, isn't it?
Yeah. Sadly, laws are a bit weird. One of the things that I try to explain to people, there's actually a case where the IRS lost because they were attempting to implement new rules and regulations as if they kind of built their own laws. And although the IRS is the government, they don't have the ability to create laws. We all know how laws come about. Basically, there's a reason why the U.S. House of Representatives exists, and the legislative side, which is the Senate, and then the executive branch, which is the president. The way the laws come together, a bill is written, as we all know, and it has to be approved by a majority of votes in both of these houses, and then actually signed into law by the president, who could actually veto it. So there's a huge process in laws coming about. So what a lot of these factions of the federal government do is they try to basically take the currently existing laws, the currently existing already passed laws, and apply to whatever different situation exists. That's why you see, cases being pulled from the 70s to apply, like the SEC has been doing, to apply to an interpretation of such a modern and innovative technology. Why? Because some principles and concepts are the same. Those things never change. But the way they are applied is where I feel we need to catch up as a government, as a country, and as a world, for that matter. And everyone is really playing catch up at this point. But yeah, the IRS basically issued a notice, which is not a law. People need to understand that. Just because there's a notice issued by the IRS, all they're basically saying, hey, look, we have a responsibility. Our job is to make sure that every person that makes money here in the United States or if you're not a U.S. resident, but you made money from U.S. sources, that you have to pay taxes here. So we have to enforce that. And so if you're making money with this new technology that we're not, it's not part of what we normally have issued information about in the past, we have to, say that we're going to treat it as something. So basically, the IRS says, if you do this, we're going to treat it like this. That's how they came out with the notice in 2014 saying, all right, a lot of people are making money with this. If you make money with this, basically, let me give you some instructions on how to report it. Report it as if you're making money with property, as if you're buying and selling property. So that they gave you a Q&A back in March of 2014, kind of give you some, hopefully some, in their mind was, I guess these are all the questions that, crypto investors would have. But as you said, sadly, since then, there hasn't been any new instructions. And there's been a lot of innovation that's taking place in the crypto, community, in the crypto world, where it has brought so much new technology, so many new ways of making money. We had everything from, ICOs, as we know, to different types of tokens now, like security tokens and all those things that we all know, and things like consultants that have been providing services getting paid in crypto. I mean, there's all kinds of different things and different strategies and different ways of making money in crypto now. And so the IRS hasn't done anything. And that is definitely a problem.
Right. So why don't we start from the basics? But that's a really good point, because I wanted to ask you, if it's pretty straightforward that you owe taxes for gains when you sell Bitcoin into fiat. It gets a lot more hairy when you're talking about stable coins or utility tokens or all these different versions of crypto assets. So can you just walk us through what types of tokens, what crypto assets are applicable, and when you might be selling one coin for another, but it doesn't trigger a taxable gain?
That's actually a great question. And I think one of the reasons why people in the crypto community often get confused with that is because of the concept that comes from technologists, right? People that understand the technology behind each and every one of these coins, each and every one of these tokens, and even stable coins and whatnot. And they are extremely and uniquely different in the technological aspects. But when it comes to the basics of making money with these coins, the IRS has never proposed anything unique about them. On the contrary, the IRS basically calls it all virtual currency. So whether it's a stable coin, whether it's a specific utility token that was created for a specific utility, or even a security token, whatever it may be, it comes down to basically the IRS saying, no, it's all virtual currency or convertible digital currency, which basically means that there is a real, I hate that they put it that way, there's a real money value to it, meaning there's a fiat value to it, and it can be traded, and it's digital. So anything that falls under that category is considered virtual currency. So the same rules apply. So whether it's a stable coin or not, it doesn't matter. Whatever trading you make, it will be considered a taxable transaction, a taxable trade.
Okay. And then it's a whole other story of whether or not that triggers a gain or a loss, and what the consequences of that might be for your, fiscal year. Obviously everybody's situation is different, but it's really helpful just to hear these general guidelines and the way that we should be looking at what our situation might be. Are you primarily U.S. focused, or do you have any background with any tax law from other countries as well?
I do. I'm actually, I've got a large clientele of people from Latin America that does a lot of investing here in the U.S. So we do a lot with setting up corporate structures involving their whole international investing, and not just one country. So I do work with some international attorneys, a lot of local accountants in different countries. And so I've had some experience in a few countries, not all of them. There's a lot of laws and a lot of information out there, but yes, I do work with a lot of, and we do set up a lot of offshores and in the crypto, since you've asked, because it does make sense, I've been able to offer some of those services to non-U.S. People, because there's some strategies that you can do with different countries where you can build your portfolio tax-free if you just kind of prepare and plan it a little bit, and that's definitely something that we try to help some crypto people as well.
Yeah, that's a serious hookup. That's really nice.
Yeah.
All right. Why don't we talk about keeping track of trades? I know a lot of the Discord community in Cryptocopia, they tend to be traders, and if you're trading upwards of 50, 100, more than that, times a year, how should you be logging those trades? What kind of software do you recommend?
All right. Well, record keeping is a big deal with the IRS. A lot of people don't know that, but it really is. Um, the, the sadly, when a new industry begins and takes such prominence like crypto has, and I hate to call it an industry, it's so much more than that, obviously, but nonetheless, there is the whole side of the money making part, and when a new industry like that takes place, there aren't very a lot of great tools out there to use. Sadly, new tools have been coming. I've been testing different things, and I kind of settled with using something that can just help my clients centralize all the information, right? So that it's all kept in one place, so I can at least so I can have access to that information and then use that to build on that. But it was so frustrating when I first started this that I ended up developing a tool myself because it was just impossible to use any of these tools. They're just not reliable. And I hate to say it. And I've actually gone even to Bitcoin on Tax's Twitter and I mentioned this and I said, look, you guys software simply, makes mistakes, some clear mistakes. There's a lot of, things such as trades that come out with zero cost when there should be a cost. And I mean, just all kinds of things. And partly it's their fault for not really investing in their software, I believe, but partly is because it is a new innovative thing. And so we have everything from reliable exchanges, as we know, like Binance, Bittrex, and all that, and unreliable exchanges. So there's a lot of them that that were there and they're gone. So there's all kinds of different situations.
A lot of those.
Exactly, which I understand. The limitations on a tool like Bitcoin.tax, for instance, to help. But the two major tools that my clients use is Bitcoin.tax or CoinTracking.info. However, I must be very, very clear about this. Do not rely on the forms that you get from them at the end. They're very good at helping you put together your trades. And don't even rely on when you click to make sure that there aren't any unmatched trades, that in fact there aren't. I've developed my own calculator that basically does that, and got a little software that validates everything. And it's almost every single time we encounter problems with reports from Bitcoin.tax, which is very scary because once the IRS begin their audits, which I'm sure they will, there's going to be a lot of issues because of that, which is sadly because someone who's a crypto trader is trying to do the right thing. They're using a tool that seems to be right, and they're entering all their information properly, but they're not really getting the right, the correct reports and forms that they would need to file their tax, at least incomplete forms. But Bitcoin.tax and CoinTracking.info are usually the two that I use the most, at least to centralize all information. And there's many ways to use them. You can learn when you go online, but basically there are APIs that you can pull information directly from exchanges, and there are ways of downloading trade history, and even from decentralized exchanges. Some of them have, some tools online that you can download trades, and then you can you can format them according to whatever needs CoinTracking.info has or Bitcoin.tax has, and then just upload them there and have the information ready for your accountant to help you prepare your taxes.
Okay. All right. So as maybe, I would call you a power user of these two sites, since you have so many clients that you're, prepping taxes for. Would you say that the support with these websites is pretty helpful? Can it be kind of difficult to get in touch with somebody sometimes?
Yeah, it's terrible. Bitcoin.tax has made their support a little bit better, and especially when you go on Twitter and you rant a little, they do get back to you. So their support has been a little bit better. Coin tracking, it's been developed by a German developer, and I think that's the team. They're German, so they never did anything about, for instance, the like-kind exchanges on reporting or anything like that on their site. So it's limited in that sense. And although Bitcoin.tax has done it, I've never used their report because it's always been unreliable every time. But when I sent them an email after renting on Twitter and they got back to me, Bitcoin.tax, that is, they did say they've been working on trying to make it better. So that's as far as I know. But their support initially was very bad. It's getting better.
Okay. It's at least a little encouraging. It's still kind of frustrating though. It was kind of a leading question because I think I've actually run into the same problem. to be fair, it was during the bull market. So literally everybody had the exact same questions and they were all reaching out at the same time. But I was using coin tracking and they have like a full library of sort of just support advice. It's not really, real time. I don't even know if there was a chat bot or not, but at least it's there for you to sort of research on your own if you're, willing to put the time in.
Yeah, Bitcoin.tax, I think, had something like that too, like a knowledge base where you could kind of search and have some articles and some information that would help. And yeah, and I get that too with the bull market. I mean, all of a sudden they were inundated with questions and requests and tickets, I'm sure.
Yeah, no, it's a very real problem. I'm sympathetic to them because, it's not just one country reaching out, it's everybody in the world since this is such a global phenomenon. We kind of already touched on it a little bit, but I was wondering about, the IRS not updating their guidance, right, from 2014. I know you already touched on why they might not have, especially the fact that they're not passing these laws. It's really, they're reliant on Congress to issue new laws that will or will not impact people, or carve out those swimming lanes and explain how things should work. Do you have any sort of speculation as to when some new guidance might come out?
Well, yes, you're right. I mean, they're not supposed to issue law, and they have to rely on Congress, but they still have a job to do. Their job is to educate the taxpayers about how to properly file and pay their taxes. And of course, enforce that by making sure that compliance is being enforced. And so there's the one thing about this government, and I love this country, and a lot of countries have this as well, is to create checks and balances. And there is an organization, it's called TIGTA, which is the Treasurer Inspector General something, I don't remember off the top of my head, but basically their job is, amongst other things, is to keep the IRS on check, is to make sure they're doing their job. And so they will often do audits on their procedures and how they're dealing with things. So it's kind of interesting when you look at the history. Bitcoin, white paper was, started in 2009, right? And then trading began soon after. And then things got really good. And then in 2014, the IRS had a lot of pressure because people were making a lot of money. So they're like, you know what? And not only that, but things were happening with the SEC as they were interpreting Bitcoin and other things. So there's different factions of the federal government having to also do the same thing, which is to basically say, hey, we're going to treat it like this. Like if you're doing it this way, we're going to treat it this way. If you're doing it that way, we're going to treat it that way. You see a lot of that with the SEC and other factions of the federal government. And then, of course, the IRS felt a lot of pressure, as they should. And so they issued the notice. But then they sat on it, like you said. They haven't done anything. And then TIGTA, a few years later, I believe it was 2000. I can pull that up. But a few years later, they basically said, hey, what have you done? I get it that you issued the notice and you gave some information, but you haven't issued a publication, which is when the IRS issues something very based on interpreting the law for something specific. You haven't included any information about cryptocurrencies or virtual currency, whatever you want to call it, on any publications or any other notices or any other, nothing. I mean, I don't see it anywhere else. And not only that, what have you done to enforce it? What kind of enforcement have you put in place? And so they got their hands slapped bad by TIGTA and said, look, you need to do something. And basically what TIGTA does is they propose, new things for them to do, like new procedures. And so they made a lot of, and you can find this online. I asked you about links. I gave you a list of links, and I don't know if maybe we could set it somewhere. But here are the dates. So, and these dates are interesting. Remember, March 2014, the notice was issued by the IRS. September 21st, 2016, TIGTA, the Inspector General, the Treasury Inspector General for Tax Administration, they issued a report presenting the results of the review to evaluate the IRS strategy for addressing income produced through virtual currencies. And then what happens? And then in October of 2016, the IRS gets an approved summons by a judge ordering what? Ordering Coinbase to turn over all their records. So you see where that came from. Basically, the IRS felt the pressure, said we need to do something. So the IRS has the right to summons information when they're investigating something. And so they got an order approved by a judge to ask for records for Coinbase. But then, as which is common in this industry, they ask for everything. We want information on everybody and everything. Yeah, and of course, we all know what happened. Later on, it got
that
changed.
Didn't go over too well.
No, and of course it wouldn't. But the point of that was to say, okay, that thing with Coinbase was mostly to make Tigta happy, believe it or not, to say, okay, we're going to do our job, but which is sad because they did that, and still since then they haven't done anything else.
Right.
There's different reports here and there, but you look everywhere and there's nothing else being done. So not even Tigta reports have been issued since then. So you asked about speculation about any new things that could come. I don't know that anything's going to happen anytime soon. I think what the IRS is doing at this point is waiting for Congress to do something so that they're not in trouble, I guess, in doing anything else. That March 2014 notice interpreting cryptocurrencies the way they did was probably the safest way of doing it. That's how they probably imagined it. That's what I think. Because that's a simple way of helping people to understand how to report it and how to pay taxes on it. Because people can relate to the concept of property. Although they could have done, say, treated it as stocks, but they didn't. And the reason why they didn't is because there's some other rules and regulations that apply to stock that do not apply to cryptocurrencies. They could have also called it an actual currency, which is another law that exists about foreign exchange, like calling it a foreign currency. But they also didn't do that. So they went with the safest bet and just calling it property. Because remember, all these things that I'm mentioning are also property. But when you just call it property, you're limiting even more of the rules and regulations to what it is. Mm-hmm. I was actually fine with that because of the possibility of doing like-kind exchange. But unfortunately,
that's something I also wanted to ask you about. But that's not something that we can do anymore, correct?
Right. And that's why right now, I'm only mentioning that because it brings to mind what you asked about what's in the future. Of course, it's hard to say what's in the future, but I think if like-kind doesn't get changed again, which I don't think it will, because it would take, once again, a whole tax reform, a whole bill to be approved by Congress, and then eventually get signed into law. So until that happens, most likely what's going to happen is they're going to have to reinterpret that notice into something else. And the options are very limited, like what I just described. And I think what the best option right now would be the foreign currency to basically transform, consider it a foreign currency. Because at least that'll give us that little exemption, which is like $200 per trade, per exchange of gains that would not be taxable. So that's kind of interesting. And
yeah,
people would make little trades, a bunch of little trades, I guess.
I wasn't aware of that. So if it's a foreign currency that you're trading and you're on multiple exchanges, you can claim a $200 exemption per exchange per year. Is that how I understand that?
Yeah. And the reason why that exemption exists, I'll tell you, here's why, right? Let's say you want to travel to another country, right? You're going to go to Italy or whatever. Mm-hmm. And then you're going to go to Japan and you buy some yen, right? And you bought yen at X amount per dollar, right? And so you travel to yen and then you spend there a week, and then something crazy happens in the second day where yen's value goes up like nuts. And then you're spending yen now, and then you have some left and you come back and then you exchange it. Now you made money. You just had a gain. Technically speaking, you need to report that and pay taxes on that. But the IRS says, look, and not only that, but on every trade that you made, on every little time that you exchange that. So they're saying, look, if you made up $200, you don't even have to report it. We're fine. You don't have to pay any taxes on it.
Okay.
But that's the idea behind it. But that's with foreign currency, fiat. So if they were to consider cryptocurrency interpreted as fiat, treating it as fiat, then yes, that would apply. The $200 exemption would apply. So that would be interesting. But I don't know if they're going to do that.
Okay, that makes sense. And you know what? Why don't we just cover briefly what like-kind exchanges were? They were something that you could use up until, well, I guess up through 2017. So you could have used them for your 2018, your 2017 return that you were filing in 2018. But what is a like-kind exchange, and why were traders able to use that last year?
So obviously, just re-emphasizing, that was a law change. That was an actual the tax reform was actually, hey, we're we're passed the law into Congress. It's been approved. The president signed it into law. So that's why that is significant. But basically, and politics aside, I have many mixed feelings about every president. Trump comes out and he said that, President Trump said that, hey, we're trying to simplify the tax code, and which is hilarious, because one of the sections that was introduced in that tax reform bill is one of the most complicated sections, which is a new interesting tax deduction that exists. It's Section 199A, but we don't have to get into that. But the way that he simplified Section 1031 is he limited to real property. So he added the word real before property. That's all he did on the like-kind exchange section of the IRS. Our federal laws are separated to titles, right? U.S. title number this and number that. So the Internal Revenue Code, which are the laws that the IRS has to abide by, is Title 26. So when you hear people saying section this, section that, section 1031, basically it's U.S. Title 26, which is the Internal Revenue Code, and then whatever sections are under that. Section 1031 is one of the sections that allow you to do like-kind exchange, and that's existed for many, many years. And the concept behind that is if you have property, asset, an actual asset that you own, whether it's tangible or intangible, and you trade it for another property that is deemed like-kind. Now, there's some rules about the deeming of like-kind. Then that it's not automatic, you can elect through a procedure to treat that one exchange as a like-kind exchange. And what that does is basically it creates no gains for tax purposes. And the way that it works, just so you understand, is whatever your cost, whatever your basis is on property that you are exchanging, basically passes on to the new property that you are receiving, right? So making it easy, I have a baseball card that I paid $500 for, and let's say it's worth $3,000 now, and then I trade it with another baseball card that it's worth $3,000. Although I paid $3,000 for this new baseball card with my baseball card that was worth $3,000, if I elect Section 1031, my cost on this card is not $3,000. It continues being the same cost that was on my original card, which is the $500. So if all of a sudden the value of this card goes up to $5,000 and I sell it, my gains is not going to be only $2,000, because remember, my cost on it is still $500. My gain, if I don't elect again at that point, it's going to be $4,500. Now, if it goes down, and this is what's really great about the like-kind, if it goes down, say, to $1,000 and I sell it, I panic sell, right? Then I'm not going to have a $2,000 loss. I'm only going to have a gain of $500. So with the huge volatility that the crypto markets brought, like-kind was the saving concept, was a saving thing here, because you could end the year, as we've all experienced in 2017, and with a very, very high value, and even beginning of the year with high values, only for May and June to hit, and all your values are gone. And then all of a sudden, then you got taxes that you got to pay, and all the things on all these gains from 2017 that you just don't even have the money for, or the assets that value that. So that was a huge problem. But if you were to do crypto-to-crypto trading and elect Section 1031 for all of those, then you wouldn't have that problem, because you wouldn't have any of those gains to pay taxes on, number one. And number two, when you actually did sell them, that and you were not going to elect that would be taxable, you would only pay taxes on the actual gains at that point. Okay. So people get confused with the word deferral, because the concept of Section 1031 is called deferred gains, as if those gains are actually going to be pushed forward and you're going to have to eventually pay taxes on them. But basically, the best way to describe it is when you elect for a Section 1031 exchange, like-kind exchange, no gains, and the cost just pushes on to the next property. Okay. Another very important thing about like-kind, another great benefit, is that you not only carry forward that cost into that new asset, right? But you're also carrying the date of purchase. Now, why is that huge? Because when you finally sell whatever asset to any taxable transaction you're going to pay taxes on, it's going to determine short-term or long-term gains, which makes a huge difference in tax percentages, right, in your tax rate. If you've done like-kind for long enough, those trades then become long-term. Even though you've bought, let's say you had an asset from 2015, right? that you kept it, and then 2016 you traded for something else, and then you traded that for something else, and you traded that for something else, and then you elected Section 1031 in all of those trades. During 2017, you traded, and then at the end of 17, you finally sell it to cash, right, to fiat, and you hold on to that. That would be a taxable transaction at the very end, but you did Section 1031 all the way through. But let's say you bought what you actually sold at the end of 17, you bought on November, and you sold it on December. But you bought with crypto, which was also elected on that Section 1031 trade. Well, guess what? Your date of purchase for that transaction, even though it's November when you actually did purchase it with other crypto,
right?
It takes that very 2015 date of purchase of when you originally did that, which was transferred over.
Very cool.
Then you get the long-term tax effect rather than the short-term. So that's huge for those who, especially from 17 to from 16 to 17, especially, and 17 to the beginning of 18, the effects of that.
And I mean, it's a massive difference from, short to long-term games. The percentage is what, like probably 10, maybe more percent difference between 10 long and short.
Yeah. In 2019, it's changed, but up until 2017, 2018's changed. It was long-term would be 20% plus it's scalable. So it's people use fixed, the IRS doesn't have fixed tables. It's very confusing, sadly. This is one thing I hate. As an accountant, I love to try to break it down in the easiest way possible so people can understand. And I am a firm believer that if you're very good and you really understand things, that you can teach it to a 5-year-old. It's just how it is. But some things are complex. I hate to say it, but the way that taxes are calculated, there's so many different ways. It does get a little complicated. But let me just put it in the most general way. Long term would be about 20% up until December 31st, 17. Short term, it's all the way up to 39.6%, which is the regular ordinary income tax rate. So it's almost 20%. It's almost half. So it's a big deal.
Yeah, that's significant. Why don't we talk a little bit about, since we're in a bear market, harvesting tax losses. As I understand it, if you had a net loss in 2018 and you're filing taxes right now, then if you had, if you sold enough to cover and register that loss in 2018 for all of your trading activities, then you can actually claim a loss against any other taxable income that you gained from investments in the year, and then actually lower your tax liability. But could you explain that for us?
Yeah. So fiscal planning, which is what we're talking, tax planning, is the name of the game. I mean, that's the most important thing. That when you hear all those billionaires and you hear, how come he's only paying so little taxes? It's because they pay a crap load of money to people to sit there and actually plan out all of their moves, ahead of time, thinking of all the tax consequences. So yes, it's important to think of tax consequences. Of course, you have to be careful. I've seen people, be so concerned about the tax consequence that they miss out on huge gains. So it doesn't make any sense to do that either. So you do have to go after the gains, but you want to do it in the most smart, possible way as well. But I got to be very, very clear about this. People get this very confused, especially those that have gone with like-kind exchange. If you bought a lot of assets when things were very high, but you did it with crypto to crypto, and you elected Section 1031, you have to remember that your cost on that crypto that you bought, even though it looks high on paper because that's what the trade was, you actually have a carrying cost from 2015 or whatever that was very, very low. So let's say you bought Bitcoin at $20,000, right? If you were courageous enough to do so, and you used Ethereum at the time, and you took a bunch of Ethereum and you bought. If that Ethereum is part of the pool of assets that you have been doing Section 1031 for since, let's say, 2015, you could have invested $100 in 2010, whatever, and then just built on that, right? And carry that over and over again, and all of a sudden you have $20,000 worth of Ethereum that you're buying with Bitcoin, but your cost is $100. So if you sell that Bitcoin when it's really low at $4,000, you're not harvesting a $16,000 loss. You're creating a $3,900 gain.
Okay,
do you
but
understand
that's
that?
only if you elected to use like kind.
Exactly. So we have to be very careful when doing that. One of the things that I tell people about fiscal planning, special or tax planning, especially when we're dealing with so many different factors, so many variables like crypto, is to do what I often do with some of my clients. They basically um, give me up to a certain moment of the year all of their trades,
Hmm.
and then they kind of plan out, hey, I'm going to probably be trading this way. Can you tell me if it looked like this, how much taxes would I pay, considering my situation? Why? Because there's a lot of variables. There's other incomes. There's other things that come into play. A person is single 1 year, then they get married. There's different tax rates. I mean, there's all kinds of things. And so then, I prepare a mock return, basically. And I say,
Okay.
look, if you did it this way, it would be like this. But if you made these changes, it would be like that. So when you're going to harvest losses, when you're going to try to do something like that, you definitely want to do it with a tax professional helping you, because you want to make sure that your decisions are smart. Like, I had people that called me and says, hey, I did great. I harvest a bunch of losses, and they just created a bunch of new gains because they thought that I bought it high, I'm selling low. But when they bought it high, they had a very, very low cost basis, and then
Yeah.
it created all of these things. So it's important to know that. But one of the things that is important to think about right now is in harvesting losses is worthless crypto. Um,
Mhm.
we have to be very, very careful with that. The IRS allows you to deem an asset that you own worthless. And when you do that, basically, it's kind of like you're selling it for zero. And you can actually do that on your trades, not actually traded, but on your like Bitcoin tax or wherever it is that you're doing is just sell that crypto to zero, even though you still have it on your wallets. Now, why would you do that? Well, let's say you bought an asset in a project that they were scammed and everybody left and they're no longer working on the project. The asset still exists because we know once it's in the blockchain, it's forever, right? I mean, so it's sitting there. You still have it on your wallet, but you can't. It's not listed anywhere. You can't sell it. You can't use it.
Okay.
It's worthless. So if you come to that place, you can go ahead and sell it to zero, and then that would be a loss. But remember, whatever cost base you had is what that's going to be a loss. So that's one way that you can create. Now you may say, well, what if someone else takes over the project and builds it up again? All of a sudden, it's valued a bunch of money later on. Well, if that happens, then when you do sell it, you're going to sell it at zero cost, and you're going to just get a bunch of gains on it, and that's fine if that happens. You just have to make sure that when you do harvest the loss, that you actually do have a cost basis on it, that it's worth doing that, because you may not. But and you also have to make sure that you're not, you can't say, oh, all my Ethereum is worthless now. It's impossible to say that, because Ethereum, like Bitcoin or other coins, there's such a fungibility, right? I mean, you can definitely trade it, you can definitely sell it for cash. There's so many ways of doing it, so there's a value to it, and it's easy to do that.
Mhm.
So you have to be careful what to call worthless and what not to call worthless. Another thing is now this is even more aggressive, and you have to be very careful. And this is the kind of stuff that usually I'd like to talk to people directly about, because it can be interpreted incorrectly. So I'm going to premise with a disclosure here and say that this part is not tax advice. It's just what I've seen as experience. But some people have developed creative ways of investing into ICOs. Kind of like the difference between buying a product and doing like layaway.
Mhm.
So you understand? So the sending of your crypto into an ICO, depending on your SAFT or whatever contract you have with them, could be interpreted in a way that, hey, until this happens, I don't really own those coins. I still own my Ethereum, which is really great because it kind of helps both sides depending on how it's done.
Okay.
But it's something that's got to be done very carefully, because there's a concept called substance over format, which is a legal concept that basically defines when, if you're doing something, even though you did it properly in the format, if the substance was to avoid something that you shouldn't be avoiding, then it could be ruled against you, and you'd have to pay taxes on it. So you got to be careful with it. But there are legal ways to strategize investments, and you would say, well, why would I want to do that? Because when you send the Ethereum, say you invested in ICO in the beginning of 2018, Ethereum was very high, and now it's very low. So now you're getting all these coins that you can't sell yet because they're not tradable yet or whatever, and now you're stuck with a huge gain from when you invested in the beginning of 2018, because remember, we don't have the like kind this year, and now you're stuck with all these gains without being able to actually take any loss or harvest any losses against it. So if you look at your contract, maybe it says something different like that, then you could say simply not consider when you sent the Ethereum as the date of purchase and consider the date of purchase when it actually became yours. Once again, take it with a grain of salt. It's very aggressive, and you definitely want to speak to your tax professionals, whoever you use, to make sure that this is good.
Okay. We put a disclosure in front of our videos, by the way. This is it's helpful, but it is not, professional tax advice that you should hold Igor to. Definitely hit up your local, tax specialist, or hit up Igor. I'll later on, I would love it if you would just let us know the best place for us to reach out to you if anybody does have questions.
Absolutely. Yeah, we can do that.
So we don't have any community questions right now. I'll just keep going. But if anybody is wondering anything specific, then please let us know in the AMA thread, and we will definitely get your question over to Igor. So how do the IRS treat airdrops?
Okay, so airdrops, if it's done like it normally is, basically you don't even realize it, and it just appears on your wallet, or a hard fork takes place, and all of a sudden you receive new coins because of it. That's not considered income. The concept of income, I have a link also in our list of links about publications that explain this, but
which we'll post, by the way. I'm sorry to cut you off, but we'll make sure to post that in the video description so that everybody has it.
Yeah, there's a publication that talks about what's taxable, what's not. So it's very good. It actually describes a lot of details under like miscellaneous income and other types of incomes. It even it covers theft. Like if you steal something, you need to report it and pay taxes on it. A lot of people don't know that. And there's a rule. If you return what you stole the same year, then you don't have to report it and pay taxes on it, which is interesting. And funny that the IRS would even cover that. But remember, Al Capone went to jail because of tax evasion, not because of killing a bunch of people. And so that was how, you can seriously get caught. Just because you're doing one crime doesn't mean that you should do the other one. So, but the point is, it's very good to look at what's taxable and what's not. But airdrops, basically, of course, it doesn't list airdrops in that list. But the concept is that if you didn't really provide services for it, if you didn't really work for it, then it's not really considered income. You're not really paying. You don't have to report it as income because you're not really paying and pay taxes on it. It's kind of like receiving a gift, like a sample in your home from someone. Somebody sent you a sample, and it's a product and it's a value, right? Mm-hmm. And you use it. You're not going to pay tax on it because you didn't really, you didn't really buy that or actually try to even get it for whatever service you provided. But it's important to understand that people, the gifts. When somebody sends you a gift, that's not an airdrop. And this is what I think it's more important to understand. There's actually a gift tax, and the gift tax is not on the person receiving it, but it's actually the person giving it. So there's a limit. You can only give up to a certain amount a year, and it changes every year. I think it's like $15,000 right now. And if I could gift you $15,000, and that wouldn't be a problem. I could not take that as a deduction. You don't have to report it as income. If I gifted you $20,000. Then that additional $5,000 that I gifted you, I have to report and pay tax on that. And that can go all the way up to 40%, which is kind of crazy.
Wow.
So, airdrops are not gifts. But so, the way to do it on the record keeping is to simply record a zero cost purchase. So basically I bought this for, 0.0001 cent, because you have to put something on Bitcoin.tax or else it thinks it's a crypto to crypto trade. And then you just, report it that way. Of course, when you sell it, then whatever monies you get, it's going to be gains, because at that point, you don't have a cost. You have a zero cost basis of it. So that's the concept of airdrops. And the same would apply airdrops from hard forks or whatever it may be.
Thank you for clearing that up. All right, let's get into a specific of filing. If you're filing and organizing your gains using last in, first out or first in, first out methodology, I was wondering if you could just explain the difference and which you prefer, because I know that it's something that can make a huge difference with how much your tax obligation is at the end of the year, but it can be a little complicated too.
Well, and there are other ones too, like average cost and other things too that you could use when determining the method that you want to do it. But it's important to understand one thing: once you choose a method, you can't be changing it. So you have to, be careful. And not only that, when you're doing Section 1031, you have to use FIFO, which is the first in, first out method. But there are some strategies that you can do by incorporating, and that's what we often do with a lot of clients as well, is create a legal entity where they could use a method in one way and then incorporate those assets into a company, and the company has a different method. So that would be a workaround that you can do. Of course, you can only do that the one time, but you can, depending on the year and when you do it. Like we had a lot of clients that did it in 17 FIFO, and then changed it in 2018 because of the different, situation of the market. Mm-hmm. So that was important. So you might want to check it out and see. And also, you could do some in a company and some in your personal return and have different methods there. You just have to be careful in how you do all of this, but it's definitely possible to. So there's not a preferred method necessarily. It would be what works best. What has the best benefit tax-wise for you. And remember this too, though. Although the name of the game is to defer taxes, right? You want to try and push it as much as possible ahead. Mm-hmm. But you got to be careful, because if you're deferring a lot of taxes from, say, one year, say 2017 into 2018, but you are expecting to have a lot of gains in 2018, then you might not want to do that. You might want to pay the taxes in 17 so that you have a higher cost basis and have less of an impact in 18, because everything is scalable, right? Mm-hmm. So your percentages, tax brackets, you could be in a higher tax bracket because all of a sudden you're now at a higher gain in 1 year because you deferred so much into that 1 year.
Okay.
Does that make sense?
Yeah, that does. And then those methods, LIFO, FIFO, I forget the third one that you mentioned. They're basically just the way that you organize and derive the tax liability from all the trades, like the order in which you list out the trades, whether you're considering the cost basis from the very beginning of your trading history or from the very end. Do I have that correct?
Yeah, or the average cost, for instance. Think about it this way. Let's say you have a drawer, right? And then you put your crypto in order as they come. So you get a new crypto and you put it in the very beginning of the drawer, and then you start putting crypto in the back. So when you're going to sell it and you open that drawer, where do you pull it from? Do you mix it all up and then pull one of those and kind of average it out so that it's all the same? Mm-hmm. Do you take it from the back or do you take it from the front? Right. Now, why does that matter? Because the crypto you bought from the front, you paid very little, perhaps. The crypto you bought from the back, you paid a lot. So if you take it from the back and you sell it, you're going to have a little gain, right? Mm-hmm. But as you continue selling it, because you have to, you're eventually going to start getting close to the beginning. And if the market goes up, now you're selling crypto with very low cost at very high values, and you're paying huge gains. Yeah. So it really depends. You're not really saving money in taxes by doing that. You're deferring. That's all it is.
Okay. Makes sense. What else? What would you say is the topic that the IRS most needs to clarify with all of the different pieces of crypto and how it affects our revenue? What do you most have questions about as somebody who is an expert in filing taxes?
Well, there's a lot of stuff that needs to there's a lot of things. There's a lot of detailed things, but I guess if I could pick one, it would be what now, since the change of the like kind, because there isn't any kind of, well, I guess there are other markets that you could compare to the volatility of crypto, but I don't think there's any other market with this many young people involved that aren't doing the kind of planning that a lot of these big, venture capital companies are doing in other markets that are volatile as well, to handle this kind of, huge gains without being ready for, to be able to pay taxes. So it's creating a problem. The like kind was a bit of a solution to that, because people always felt, as it relates to crypto, that as long as I don't bring it to fiat, then I'm okay. And of course, we've all gone past that. We understand that's not the case now. But like kind of still made that true, if you think about it, because whatever crypto trade, if you elected like kind, you'd be okay and not have a problem with having to pay taxes on it. But now it's no longer that way. So that definitely needs to be addressed. I mean, 2018, it's going to be the year, I feel, especially because of the difference in the market, that a lot of people that are in crypto are going to be scared to report all their gains. They're probably going to be doing a lot of wrong things, and that's where the problem is going to really be become a serious thing. Where the IRS is going to start auditing, and then it's going to be a serious thing. And that's what I feel is going to happen. So yeah, the IRS needs to address something, whether it's going to go with a foreign currency or whatever, but something needs to be done more than just that notice of 2014 at this point.
Got it. Let's look a little, future facing. So if a lot of the innovation, regulation wise, at least, is coming from the state level, in the past year, maybe 2 years, like I'm looking mostly at Wyoming. They've passed a lot of legislation this year. Caitlin Long, especially, and the commission or the committee that she started, in Wyoming. If hypothetically a state made cryptocurrency tax exempt, now I would imagine that would only apply to state tax obligations, but what do you think that would look like? And if I hypothetically moved there, would I still owe federal taxes? Would that change my obligation? What would the state level possibly look like?
Yeah, I mean, I know it almost sounds obvious, but that's actually a pretty common question, because it's confusing how a lot of times our laws contradict each other.
Yeah.
There's and that's within the same type of government, which is a tax government, right? I mean, it's a federal tax government against a state tax government, still a tax government. But yeah, I mean, there's a concept. I was trying to look for it now as you were asking that, but there's a concept called the supremacy clause, which basically states that state laws may and often do differ from federal laws, but they do not replace federal laws. They can't. So you're absolutely right. I mean, if you're living in a state where cryptocurrencies are exempt for state tax purposes, you still owe federal taxes on it. You still have to pay taxes on it. The good thing about that, however, besides the obvious, which you'd be saving some money in taxes with the state, is the pressure that kind of brings into the federal government. So I love to see a lot of the states creating legislation. That's kind of what happens in a lot of the different laws anyways. The different states starts putting a lot of pressure by actually passing different laws state level, and eventually the federal government starts getting, hey, you guys need to do something. Can't you see that we're as states, we're seeing things differently? What are you going to do about it? So eventually the pressure's on for the government to do. So I'm very happy to see a lot of states moving and doing and creating new legislations and passing them. But once again, I think we're far from the IRS doing anything, because I haven't seen audits. Have you ever heard of anyone being audited yet that has filed cryptocurrency income? I have not.
No.
Right. So it's been the IRS does a lot of research through tax audits. So just because somebody is being audited doesn't mean that they did something wrong or that they're in trouble. The IRS needs information, and the best way to do that is to verify returns. Because remember, when you submit a return to the IRS, it goes through a regular process. It's a computer system. It's bots, and they're using different criteria to select some returns randomly, and of course returns that are obviously wrong, or like mathematical errors or something like that. Those will be picked up as well. Okay. But it's very random on how returns are selected for audits, and the criteria that's used to be inputted into the software comes from tax audits, because they have to look at returns and figure out how things are happening. And so anything the IRS needs to do new, it starts with them actually doing audits. And I haven't seen audits taking place like I expected that by now they would, believe it or not. So that could be coming soon, very soon, where the IRS is going to start auditing a lot of cryptocurrency filers. And when I say a lot, I don't want to scare anyone. It's not. And of course, if you're doing the right thing, there's nothing to be scared of. And here's the one thing I want to tell you. This is a good tax advice. Don't ever go into an audit by yourself. Always have a representative who is experienced in tax audits that can represent you. And that's what an enrolled agent is. I'm licensed by the IRS to be able to represent clients all the way up to U.S. tax court. So I have a lot of experience. I've done hundreds of audits, and you definitely want somebody that's experienced in audits, or like a tax attorney or someone like that. But the focus is, hey, you want to make sure you do the right thing so that if you do get audited, you're fine. I mean, that's kind of my approach, is to be aggressive with the least amount of exposure. Why? Because I'm always thinking about, if I take this tax position, if I go this aggressive, and I were to sit before an IRS auditor, what impact would this have? How could I argue this? How could I defend this? And that's always what you need to have in your mind as you're doing this thing. So I definitely would encourage, once again, that you would never go to an audit without a tax representative with you. But yeah, so I think tax audits are coming. So that would be one thing that I would let people know to make sure they're prepared for sure.
Okay. Well, I mean, hopefully nobody in Cryptocopia needs you next to them for an audit, but if they did need to reach out for anything, any, questions, or they were interested in your services, what's the best way to contact you?
Yeah, they can send our company an email. Our company's general email is tax@genesistaxhouse.com. Or even send me a direct email at Igor, IGOR, at genesistaxhouse.com. And we can definitely help if it's, I can do tax representation for U.S. Customers only. Well, actually, if you are a non-U.S., but you have a U.S. tax audit, I can do representations of those as well. And yeah, and one of the things that I wanted to address that I think we kind of went over like kind, but we didn't really talk about it much, was one of the misinterpretations of like kind. I don't know if it's okay with you for us to go over that.
Yeah, absolutely.
Yeah. I know of the huge debate that comes with the whole issue of like kind, right? I mean, one of the biggest questions that people have is whether every cryptocurrency is in fact like kind. I kind of went over that a little bit as how the IRS sees it. We know the IRS definitely sees it as all being the same, or they would have done things differently. Now, one may argue, well, when they issued back in March of 2014 the name virtual currency for cryptocurrency, they kind of generalized it. That doesn't necessarily mean that they see it all as the same. Okay, that's a fair argument. But the main issue I think that people have is if one currency or one coin or a token was created with a whole network for a specific purpose, that it is therefore uniquely different from another one that was created for another purpose. And there's a bit of a misconception with that because of how people are using what people are using to interpret what's actually happening today. Now, remember, there aren't any cases, any law cases, right? Any tax court cases about cryptocurrency. So we can't go back to case law, which is one way of trying to understand how to take a tax position. You can go back to case law and see, in this particular case of cryptocurrencies, this is what the outcome was. So you have to take other cases, and then you have to apply those concepts to this concept. People have been using a lot of tangible assets cases to apply to cryptocurrencies like gold bullion or gold coins versus silver coins and so forth. And instead of using something that would be more, I feel, close to what cryptocurrency is, because cryptocurrency is a digital asset. People should really be looking at case law from digital assets like copyright or royal or trademark, something that's an asset, but it's digital, and see how the IRS has ruled or not the IRS, how the U.S. tax courts have ruled in those cases. But more importantly, they should really understand how the government, how the tax courts and the IRS sees what something is considered like kind, what is considered like kind, how do they deem it like kind. And without getting into a lot of detail of it, I want to mention an article. There's a guy called Eli Cole. He actually issued an article, and this is like, I don't know if we can see that or not.
I can see it, yeah.
There. So it's in the Hastings Science and Technology Law Journal, and I think he was a tax law student at the time, and him and his teacher worked on this. And it is the best article that I've come across that explains why cryptocurrencies would apply, why like kind would apply to cryptocurrencies, and it goes over all of the arguments that people have brought against the concept of cryptocurrencies being like kind. And remember, in this community, there's a lot of developers, there's a lot of technologists, a lot of people that really understand about the technological part of cryptocurrencies. But so obviously, when you tell somebody what Ethereum and Bitcoin is the same thing, they go nuts, and rightly so, because it's a totally different thing. But the actual coin, the actual currency, for tax purposes, it's all considered property. It's all considered convertible digital currency or virtual currency, and it is all, the same for tax purposes, at least as it relates to like kind. So this would be a great article to spend the time and read, because it really covers all of the arguments. That's what I like about this article. He covers all the arguments that people have against the concept of like kind, and he has the counter arguments to why those arguments don't fit. And then he just explains. So it's very detailed. It's an easy read. It's not, it's hard to understand. I hate when people try to make things too difficult. Like I said before, it's easy to read and digest. And I would definitely encourage people to look this up. I know that I have some clients that, and I don't want to name anyone, that have dozens and hundreds of thousands of followers on Twitter and other places, that have mentioned things like this in this article as well, that I've given them, and okay. So it's definitely something that a lot of people of weight, I guess we could say, in our community have accepted, are behind it, support it, and understand it, and agree with it. So I would definitely encourage those that have not elected Section 1031 to look at this, because if you didn't and you made some money in 2017, you paid a bunch of taxes, and you're hurting right now for sure. So look at that.
We'll definitely share that. We'll definitely post that under the video description. Thank you for sharing it with us. I mean, that document and all the other links that you included, and I mean, everything you just talked through with us. It's a really, really complicated topic. Not to mention how underdeveloped, I guess, all of this guidance is, which we covered. But yeah, we'll figure it out eventually. It might take a few years, or more than a few years. But Igor, thank you for sharing your expertise with us.
And I guess just one last thing. Just because you haven't filed or reported cryptocurrencies until now, it doesn't mean that you shouldn't. When these tax audits begin, they're going to go back to previous years as well. So I encourage everyone that if you haven't filed since 2013, 14, to go ahead and actually amend those returns and correct and file those and include all of the information, especially because the tax implications of those would be so small, but it would be just another audit. It would cost you a lot more to go through an audit for those years than to do it and just pay the tax on it. But you could even do the Section 1031 and not pay any taxes on it and just be cleared of any issues with it. But I would definitely encourage you to go back and report everything that you haven't reported yet to make sure you're up to date. We often do that with many clients. As soon as we take on a client, we go back and we look at their returns and what they've missed, and we amend all those returns and include everything. So these softwares like Bitcoin.tax and CoinTracking.info, and you can enter information from previous years as well and get all that to us, and we definitely work with that. And it's great. So I'm one of the accountants on I have an accountant account with both Bitcoin.tax and CoinTrack, so I can actually access your account with you if you give me the permission. So it's a good way to work together with clients that way, to help them build that up so that they're reporting everything properly. And I've had people change their hearts and originally report cryptocurrencies without electing Section 1031 and going back and amending it and getting a bunch of refunds. So that's also interesting too. You might want to reconsider your position after reading that article and maybe go back and change your tax position. That if you're not in an audit, you can still do that. If your return gets audited, then you can no longer do that. So it's definitely something to consider before a lot of these tax audits go out. Okay.
Fantastic. Well, listen, that wraps up our AMA for this week. Cryptocopia, we're doing these every week, every Thursday. We rescheduled this week, but be sure to watch out. We announce on Twitter at @crypto_copia each week's guest. I'm really excited about next week. I think it's going to be a really, really great one, as was today, and Igor, I just want to thank you again one last time. If you want to shout out your website where we can contact you, but thank you again for doing this.
Sure. GenesisTaxHouse.com, and Genesis like the book of the Bible, GenesisTaxHouse.com. And of course, my email, Igor@GenesisTaxHouse.com. If you have any questions, if you need anything, we're definitely here available and to help you guys out.
Awesome. Amazing. Well, you have a great rest of your day, sir. Cryptocopia, we will see you next week.